As I stand here, global debt is still piling up. According to the Economist debt clock, it stands at a mind-boggling 49 trillion US dollars. Who knows where it will be when you watch this documentary. What it does mean is that inevitably governments have to walk a narrow tightrope. How on earth can they roll over debt and at the same time not raise taxes? Or will they have to take the unpopular step of raising taxes and therefore making themselves unpopular with the electorate? Just ask poor old Nicolas Sarkozy of France what happens when the electorate doesn't like your recovery strategy.
It all started in the United States, of course, with the subprime crisis that led to the downfall of Lehman Brothers, which inevitably rippled even further toward the fiscal cliff that looms ahead.
And what you'll see in economics, which is not uncommon, is that the government is there to protect the economy, the well-being of the people in the economy. And they're there to offset what we'd call systemic problems. If you're a small business and you go under, that's your problem. But banking system is a little bit more peculiar because it affects the well-being of the country. And we had the situation of too big to fail, where big banks who were threatened with going under genuinely needed to be saved. It doesn't mean that they shouldn't be penalized, the people who were responsible for this, but systemic economic problems need to be addressed by the government.
In fact, the banks themselves and their practices has become more of a systemic risk than the collapse of a bank. When the banks get onto the shenanigans that the investment bankers particularly get onto, they have become the source of systemic risk, not their failure. And this is a very different game change. In 1950s, when we were talking about, or 1960s, up until late 1970s, when we were talking about systemic risk, the banks were conducting themselves very, very differently. Commercial and transactional banks were separated by law from investment banks. So investment banks were risking their own money or their investors' money. The average citizen were in a way ring-fenced and safeguarded against the risk-taking conduct of the investment bank.
The role of the government, and I put both the fiscal authorities and the central bank, is to address systemically important issues in the economy. And the crisis, the subprime crisis that happened, was a systemically important issue for the economy. Now we've got something going on in Greece, which is also very problematic, which threatens the whole Eurozone. And again, the central bank and the government, well, there's not a single government in Europe, this is part of the problem, but the European Central Bank has to address this issue. Otherwise, the banking system in Europe, which is holding all of this paper, could go under. And that banking system is holding your deposit and my deposit. If the banking system goes under, either they're going to take away your money, or if those deposits are insured, the government will still have to cough up the money in any case.
The United States has an official outstanding debt burden of 16 trillion US dollars. That's in Treasury bonds and bills. But if you add the less tangible liabilities like Social Security, Medicare and Medicaid, it gets closer to a staggering 60 trillion US dollars.
The size, the quantity of debt is not the issue. It's your ability to repay it. And that's why we look at the size of your bond or your mortgage in relationship to your income. So the US, we tend to look at the ratio of your debt to your size of your GDP. And it's true, in the US it's about 100% now, which is severe. Of course, Greece is 150%, and a number of other European countries are over 100%. But in Africa, during the debt crises, we were looking at countries that had 150, 200% or more in terms of their ability to, their debt was more than 200% of GDP. So at a certain point, you need a strategy. One traditional adjustment that creditors are asked to make is either reduce the interest, change the terms, roll out the debt. We have something called rescheduling that was done to restructure the debt. In the case of Europe, they asked a lot of the Greek bondholders to take a big bath, a haircut on the size of their debt. So in many cases, the creditor has a role to play in this as well, and it may not always be simply a case of asking the debtors to contract their economies. It might be the debtor has to expand his.
William H. Gross of PIMCO, that's Bill Gross to you and I, compiled a chart based on recent studies by the International Monetary Fund, the IMF, the Congressional Budget Office, and also the Bank of International Settlements, and he calls this Ring of Fire. Sharing the flaming ring are Spain, Greece, France, Japan, and the United Kingdom, and also the United States. Not far behind them are Brazil, Italy, China, Mexico, Germany, Canada, and Russia.
And for the countries that I mentioned, Spain, Italy, Portugal, Greece, the key problem was that expenditure kept on going higher and higher. Tax collection was flat or going down. And the commitments by the fiscus in those countries were so large and expanding all the time that the situation became unsustainable. And I'm talking here about retirement provisions, pension provisions. I'm talking about costs of medical care, all kinds of costs related to state expenditure for the public. And bear in mind that most of these countries tried as much as possible to be social democratic states, social democracy which I very much support. But social democracy also presupposes that the state has an ability to collect tax. That's why the Scandinavian social democratic societies have been able to ride this debt problem. Why? If you take Sweden, the Swedish authorities collect tax. And they make sure that the richer you are, the more tax you pay. But these other countries, some didn't collect tax, but they wanted to live like the Swedes, but they didn't collect the tax. Now you can't have it like that.
So basically, society started to create benefits, social welfare, which was unheard of before the Second World War, even in the immediate aftermath of the Second World War. And that had to be financed. And there's only two ways the government can finance that. One is by taxation, which is about as popular as Ebola fever, or by borrowing money. And they started to borrow money. And that led to the buildup of debt. And we saw that buildup of debt in different ways in different countries. And despite protestations from politicians on both sides of the actual political divide, and there were certain other things as well. For instance, the United States debt has to do with the Vietnam War and various military campaigns in the Middle East. But in Europe, for instance, it's much more to do with the social welfare state and the expectations of the populations. And as everybody knows, politicians like handing out freebies to basically win elections.
So welfare expenditure is the problem. Elections are more like auctions. And so what's happened is that your political establishment in Europe, US, Japan, etc., have promised to the electorate more than what their tax base can actually deliver. In other words, it's like a household that is spending more than what's coming in, and that household will be financially distressed. Same with the country. They spend consuming more than what they're producing, and the countries are financially distressed. Very, very easy to fix. If you just, as a household, start spending less than what's coming in, the situation stabilizes and starts to improve, and actually can repair itself quite quickly, funny enough, if you actually stick to that formula of spending less than what's coming in. And likewise, Europe, very easy to fix. It's not as if that they're an unsuccessful economic region. They just need to stop spending or consuming more than what they're producing. The only trouble is it's politically impossible. And because it's politically impossible, the situation remains unstable and deteriorating.
In some ways, we've had the tipping point when you look at the subprime crisis in the US market in 2007, 2008, when it basically became clear that US households had very high leverage or were over-leveraged. We had sort of the tipping point in the US property market, and from there it's been spreading. And what we are seeing at the moment in many countries, the US included, Europe included, that we are going through a prolonged and very difficult, very painful process of deleveraging. And that process just takes a long time. That's also, on the other hand, the reason why we are not seeing the global economy kind of pulling out and going back to a higher path of growth.
The system had just taken on too much debt. And so 2008 came and it never ever really went. It's still with us, and it's just really metamorphosizing in Europe. It'll go back to the US. It's still going to hit Japan. There's just too much debt, and you're trying to actually sustain it with ultra low interest rates, and as a consequence, compounding that debt problem. And what one needs is to start to see capital formation. Savings rates are collapsing. And that is part of your solution, is actually to try and actually reduce that systemic risk.
Sovereign debt has been with us forever, but we used to deal with it slightly different. In ancient times, countries borrowed from each other and borrowed from banks. But what generally happened is if you didn't pay back the debt, what happened was the other country came in, took repossession or possession of your country.
So it looks pretty grim, and up next I ask the $1 trillion question. Has the current global debt situation become a real horror story?